Good day, doctor and everyone. My name is Tan Zitian and my matrix number is 305705. Today, I am going to present the quiz 3 that include in our international finance task. And now I will present 6 questions and the answer.
For question 2a, the supply of ringgit Malaysia may decrease for three reasons. First, Malaysians import fewer foreign goods. When imports decrease, Malaysians need less foreign currency, so they supply less RM in the forex market. The supply curve of RM shifts leftward. As a result, RM appreciates, meaning fewer ringgit are needed to buy $1. Malaysian consumers and importers benefit because foreign goods become cheaper. Second, Malaysians reduce overseas investment. If Malaysians invest less abroad, they exchange less RM for foreign currency. Therefore, the supply of Ringgit Malaysia decreases and Ringgit Malaysia will appreciate. Local firms with foreign debt and importers benefit. Third, confidence in Malaysia improve. If Malaysians prefer holding local assets instead of foreign assets, less RM is supplied in the forex market. This causes RM to appreciate. Malaysian consumers, importers, and companies importing raw materials benefits. For question 2b, the Big Mac costs RM15 in Malaysia and USD 5.50 in the United States. The PPP implied exchange rate is RM15 divided by USD 5.50 and equals to RM2.73 per USD. The market exchange rate is RM4.20 per USD. Since RM4.20 is higher than RM2.73, the ringgit is undervalued. This means more ringgit are needed to buy $1 compared to the PPP implied rate. The percentage undervaluation is RM2.73 minus RM4.20 divided by RM4.20 and then times with 100. This will equals to negative 35%. So the ringgit is undervalued by 35%. For question 2C1, the basket costs are M5,500 in Malaysia and USD 1,250 in the US. Using absolute PPP, PPP implied rate equals Malaysian price divided by US price. So RM 5,500 divided by USD 1,250 equals RM 4.40 per USD. Therefore, the PPP implied rate today is RM 4.40 per USD. For question 2C2, using relative PPP after 2 years, the formula is expected exchange rate equals current spot rate times open bracket 1 plus Malaysia inflation divided by 1 plus US inflation cost bracket power of 2. So, RM 4.40 times open bracket 1.025 divided by 1.038 cost bracket square. This equals approximately RM 4.29 per USD. For question 2C3, the actual rate in 2 years is RM 4.3 per USD. The PPP predicted rate is RM 4.29 per USD. Since the actual rate is slightly higher than the PPP rate, the ringgit is slightly overvalued. This means the RM is slightly weaker than what PPP predicts. Now we continue with question 3. For question 3a, a long position in the forward currency market means agreeing to buy foreign currency in the future at a fixed forward rate. So importers usually take a long position because they need to pay foreign currency in the future. They hedge against the risk that the foreign currency appreciates. For example, Proton Holding importing car parts from Japan may take a long position in Japanese yen. A short position means agreeing to sell foreign currency in the future at a fixed forward rate. So exporters usually take a short position because they will receive foreign currency in the future. They hedge against the risk that the foreign currency depreciates. For example, SIMDABI Berhad expecting USD received from exports may take a short position in USD. For question 3B1, the spot rate is RM 4.15 per USD and the 3 months forward rate is RM 4.09 per USD. Since the forward rate is lower than the spot rate, the USD is at a forward discount. For question 3B2, the annualized forward discount is forward minus spot and then divided by spot times 12 over 3 times by 100. So 4.09 minus 4.15 divided by 4.15 times 4 because 12 over 3, right? So and then times by 100. This equals negative 5.78%. Therefore, the USD is at an annualized forward discount of 4.78%. For question 3C1, SIMDABI will receive USD 1,200,000 in 3 months. Since it will receive USD, it should take a short position by selling USD forward. This is because to protect the company against the USD depreciation. For question 3C2, RM revenue under the forward contract is USD 1,200,000 times by RM 4.09 and this will equals RM 4,908,000. And then for question 3C3, without hedging, the actual spot rate is RM 4.25. So RM revenue equals USD 1,200,000 times by RM 4.25 and this will equals RM 5,100,000. For question 3C4, hedging revenue is RM 4,908,000, while unhedged revenue is RM 5,100,000. So the difference is RM 192,000. Therefore, hedging resulted in a loss of RM 192,000 compared with the spot outcome. However, the purpose of hedging is not to maximize profit, but to reduce exchange rate uncertainty. So the hedge still provided certainty. Now we continue with question 6. So for question 6a, the traditional approach has 4 limitations. First, it focuses mainly on exports and imports, but ignores capital flows. For example, in Malaysia, during 2024 and 2025, ringgit movement will influence not only by trade, but also by foreign investment flows. Second, it ignores monetary factors such as money supply and money demand. For example, Bank Negara Malaysia (OPR) decisions affected liquidity, investment and the ringgit, which cannot be fully explained by goods trade alone. Third, it assumes capital flows are less important. However, Malaysia and the US had interest rate differences. So investors compare return between Malaysian and US assets. This affected the ringgit even if trade performance was stable. Fourth, it cannot explain risk of behavior and financial shocks. In 2024, when global investors prefer safe assets such as US dollar assets, capital could leave emerging markets like Malaysia. This affected the RM beyond exports and also the imports. For question 6b1, under the monetary approach, strong GDP growth increases money demand. When GDP rises by 5.5%, people and firms need more money for transactions. So money demand will increases. If money supply does not increase as much, money demand is greater than money supply. So people reduce spending on imports and foreign assets to rebuild money balances. This improve the BOP condition and support the ringgit. For question 6b2, under the portfolio balance approach, strong GDP growth makes Malaysia more attractive to foreign investors. Foreign investors may buy more Malaysian bonds, equities, and also other financial assets. So this creates capital inflows and increased demand for RM. For question 6b3, both approaches predict the same direction, which is the monetary approach predicts stronger GDP growth increases money demand, improves BOP and supports the RM. The portfolio approach predicts stronger GDP growth attracts capital inflows and support Ringgit Malaysia also. Therefore, Bush approach predicts RM appreciation. So for question 60, now I will explain the risk of environment and the flight to safety definition first. So a risk of environment occurs when investors become pessimistic about global economic prospects and avoid risky assets. And then flight to safety refer to investors moving funds from riskier assets into safer assets such as US Treasury securities, US dollar assets, and also the gold. So how about the effect on Malaysian bonds and MYR deposits using the portfolio balance approach? So during a risk-off environment, Malaysian bonds are viewed as relative riskier. MYR deposits become less attractive, so investors reduce holding of Malaysian assets. Therefore, demand for Malaysian bonds and MYR deposit falls. So for question 62, how about the result of the capital flow and the effect on the MYR? So investors sell Malaysian assets and buy safer foreign assets. This creates capital outflow. Consequently, demand for RM will decreases and demand for USD increases. In the result, RM will depreciate. For 6C3, I will discuss what the Bank Negara Malaysia could do using the OPR, and I will explain which approach will support this action and why both ultimately agree on the outcome. So BNM can increase the OPR by using the portfolio balance explanation. Higher OPR will increase the return on Malaysian deposit and also the bonds. Therefore, Malaysia's assets become more attractive. Capital outflow slow and capital inflows may increase. Thus, the RM will appreciate. By using the monetary approach explanation, a higher OPR will discourage borrowing and spending. So money demand will rise relative to money supply. Therefore, money demand will be higher than the money supply. So this will improve the balance of payment position and supports the ringgit. Thus, the RM will appreciate also. So why both approach will agree on the outcome? So through monetary approach, higher interest rate will raise money demand and improve the balance of payment. Whereas compared to the portfolio approach, the higher interest rate will attract investor and also the capital inflow. Therefore, both approach can cause RM appreciate. For question number 8A, there are three types of foreign exchange risk exposure. So the first is the transaction exposure. This is the risk that exchange rate changes affect future foreign currency payments or receipts. For example, a Malaysian palm oil exporter expecting to receive USD face the risk that USD will depreciate before payment is received. So the second one is the translation exposure. This occurs when a multinational company converts the foreign subsidiary accounts into ringgit for financial reporting. For example, Maybank with overseas operations may report lower RM value of foreign profits if the foreign currency weakens. And the third is economic exposure. This is the long-term effect of exchange rate changes on competitiveness, sales cost and also the profits. So, for example, Proton importing foreign car part may face higher production costs if the ringgit is depreciates. For question at B1, the spot rate is RM 4.50 per USD and the 3 months forward rate is RM 4.44 per USD. Analyze forward premium or discount equals to the forward minus spot divided by spot times 12 over 3 times by 100. So 4.44 minus 4.50 divided by 4.50 times 4 times 100, this equals negative 5.33%. Therefore, the USD is at an annualized forward discount of 5.33%. For question at B2, since the forward rate is lower than the spot rate, the USD is expected to weaken and the ringgit is expected to strengthen. For question HC1, the exporter will receive USD 500,000 and sells USD forward at RM 4.22. RM revenue under forward contract equals to USD 600,000 times by RM 4.22, and this equals to RM 2,532,000. For question 6 at C2, without hedging, the actual spot rate is RM 4.10. RM revenue equals to USD 600,000 times RM 4.10, and this equals to RM 2,460,000. For question XC3, gain for hedging will equal to RM 2,532,000 minus by RM 2,460,000, and this equals to RM 72,000. Therefore, the exporter will gain RM 72,000 by hedging. So, the decision to hedge will justify because USD depreciated and the forward contract protected the exporter from receiving fewer ringgit. For question 9a, we need to test convert interest parity. So if the investor invests RM 100 in Malaysia at 5%, RM 100 will times with 1.05 and then we will get RM 105. Now compare with convert investment in the US. First, convert RM 100 into USD at RM 4.50 per USD. So we use RM 100 divided by 4.50 and then equals to USD 22.22. Then inverse in the US at 3%. USD 22.22 times 1.03 equals to USD 22.89. Then we sell the USD forward at RM 4.41. So use the USD 22.89 times by 4.41 will equal to RM 100.94. So Malaysia will give RM 105. Will convert US investment give only RM 194 cents. Since the return is not equal, so CIP does not hold. So the arbitrager would invest in Malaysia because Malaysia will give a higher convert return. So they may borrow USD and then convert USD into RM and then invest in Malaysia at 5% and use the forward market to cover exchange rate risk. So this will increase demand for RM in the spot market and changes forward market demand until the return become equal and CIP is restored. For question 9b1, using the uncovered interest parity which is UIP, the expected percentage change in exchange rate equals Malaysia interest rate minus US interest rate. So 5% minus 3% equals to 2%. Expected rate equals RM 4.50 times 1.02. So this will equals RM 4.59 per USD. For question 9b2, if the investor place RM 100,000 in Malaysia, RM 100,000 times 1.05 will equals to RM 105,000. For question 9b3, If the investor invests in the US, first convert RM 100,000 into USD. RM 100,000 divided by RM 4.50 will equals to USD 22,222.22. Then inverse at 3%. USD 22,222.22 times 1.03 will equals to USD 22,888.89. Then convert back using the unexpected exchange rate RM 4.59. The USD 22,888.89 times RM 4.59 will equals to approximately RM 105,000 and then 50. For question 9b4, the Malaysia return is RM 105,000 and the expected US return is about RM 105,050. They are almost equal. So this tells us that under UIP, which is the uncovered interest parity, the expected exchange rate movement offsets the interest rate difference, so expected returns are equal across the countries. For question 9c, using the loanable fund market, when the foreign investor increase investment in Malaysia, they bring more funds into Malaysia's financial market. So the foreign capital inflows increase the supply of loanable funds in Malaysia. Therefore, the supply curve will shift to the rightward. So we continue with the answer for question 9c. When the supply of loanable funds increases, funds become more available to borrowers. Therefore, the equilibrium interest rate will fall. Then, at a lower interest rate, Malaysian firms and households borrow more for investment and spending. This may increase economic activity. Then, foreign investors need to buy RM to purchase Malaysian bonds, equity, or deposits. Therefore, the demand for RM will increase. The RM demand curve shifts rightward, so the RM will appreciate. Now we continue to the last question, which is question 10. So for question 10a1, the Fisher equation states that real interest rate equals to the nominal interest rate minus with the expected inflation. So for example, for Malaysia, 5% minus 1.5% will equals to 3.5%. For the UK, 4.0% minus 2.5% will equal to 1.5%. Therefore, Malaysia real interest rate is 3.5% and the UK real interest rate is 1.5%. For question 10a2, real interest parity predicts that capital will flow from the UK to Malaysia because Malaysia offers the higher real returns. For question 10a3, if capital flow freely, so the funds move into Malaysia. This increases the supply of loanable funds in Malaysia and puts downward pressure on Malaysia interest rate. At the same time, funds leaving the UK reduce loanable funds there and put upward pressure on UK interest rate. Eventually, real return tend to equalize. For question 10b, the Jacob effect explains the after currency depreciation. The trade balance may worsen first before improving later. So phase 1 is the immediate period. Import price in RM rise immediately, but import volume does not fall much because of contracts and habits. Export volume also does not rise immediately. Therefore, the trade balance worsens. For phase 2 is the short run. Malaysia continues paying more ringgit for imports, while export revenue has not increased enough. The trade deficit may widen. And for phase 3 is the medium run. Import volumes start to fall because consumers and firms look for substitute. Export volumes start to increase because Malaysian goods become cheaper to foreigners. The trade balance begins to improve. And then for phase 4 is the long run, as also is the last phase. Export revenue rise and import spending falls. If the Marshall-Lerner condition is satisfied, the trade balance improves. So For Malaysia 2023 to 2025 experience, RM depreciation increased import costs in the short run. However, over time, the long run outcome depends on whether export and import quantities respond strongly enough. For question 10C1, the Marshall-Lerner condition is export elasticity plus import elasticity must be greater than 1. Here, 0.4 plus 0.3 equals to 0.7. Since 0.7 is less than 1, the Marshall-Lerner condition is not satisfied. Then for question 10C2, RM depreciates by 10%. Export volume increased by 0.4 times 10% equal to 4%. Import volume decreased by 0.3 times 10% equal to 3%. For question 10C3, the trade balance worsened. This is because export volume increased only slightly and import volume decreased only slightly. Since demand for export and import is inelastic, the quantity response is too weak to offset the higher ringgit cost of imports. Therefore, depreciation fails to improve the trade balance. In conclusion, these questions show how exchange rates are affected by PPP, forward contract capital flows, interest parity, risk exposure, and trade elasticities. The main point is that exchange rates are not only affected by trade, but also by interest rates, inflation, capital flow, investor confidence, and risk sentiment. Thank you.